We've seen one of the fastest interest rate rises in recent history with a move from 0 to almost 5%. The impact on the real economy has actually not yet translated into material adverse effects outside of a few sectors such as real estate and construction. The longer the interest rates stay higher, the more we're going to see risks for many companies in the economy. Companies with weaker balance sheets are going to find it more difficult to re-leverage or to refinance some of their debt. For many other companies, they have refinanced their balance sheets over the last few years to the point where the rise in interest rates has not really impacted their ability to finance growth for these businesses. Many of these business companies also have very large cash balances that are now actually generating positive interest income. You want to really be positioned more towards the quality end of the corporate spectrum at this point in the cycle rather than towards cyclicals, which are more impacted by interest rates. Consumers, especially within the lower income cohorts, are going to find it more difficult to finance their consumption. The return you get from a stock can be broken down into three things. There's the earnings growth component, the shareholder return component, either through dividends or buybacks, and also a re-rating component in the event that you're able to buy companies at a below market valuation. For many quality companies, the valuation component is actually quite narrow because most of the time quality companies tend to trade at what we would call fair value. So most of the return from owning these businesses will come from the fact that they can compound their earnings at a faster rate than lower quality businesses, and that they're able to allocate or distribute more of those earnings to shareholders in the form of dividends and buybacks. So while you don't necessarily benefit from a re-rating unless you can buy them during times of market dislocation when they are cheap, you are benefiting from the fact that they compound earnings at a faster rate and they distribute more of those earnings to shareholders over time. So that's why we think even at a fair price, it makes sense to own quality companies in a diversified portfolio.